Welcome to Capital Conversations, where innovation meets opportunity. Join hosts Karen Rands and Erik Nelson as they unpack the realities of raising capital, from angel investing to IPOs, and reveal what it takes for companies and investors to thrive in today's changing markets. Let's get started.
Oh, hey, we are back live. And one of the things, this is Erik Nelson and Karen Rands on Capital Conversations. And one of the great things about a live program is that you actually get it live. So that comes with all of the unexpected this, that, or the other thing that happens. And so sometimes it's me not watching the numbers that go countdown. Anyway, today, this is the third of our official type of program. We did an intro, and then we did the intro, and then we did the top of the market, like IPOs, and how last week it was like IPOs, and what do you got to be prepared for, and an intro to the concept of IPOs. And this week, we're going into hot topics. So this is about digging into things that are in the headlines right now that have happened, come out in the last couple of weeks, or even right now, because we are in the thick of a whole bunch of stuff happening in our public markets that Erik is going to dig into in just a few minutes. We're going to get into talking about the Dow Jones and the impact, and what does that mean when it comes to other things you could think about. What's the long-term thinking on some of this? What are some of the things, the movement that's already been in place with legislative actions and regulations? A whole bunch of stuff that you need to think about as you're trying to figure out what are you going to do with your own money or with your strategies as a company, thinking about how you're going to get to an exit or what do you need to do. But first and foremost, I have to offer a disclaimer. The information provided in this podcast is for educational and informational purposes only and not intended as financial advice. The views and opinions expressed by the hosts and guests are their own and do not necessarily reflect the official policy or position of any financial institution or organization. You should always consult with a qualified financial advisor and conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risks and uncertainties. We do not guarantee the accuracy, completeness, or usefulness of any information discussed. By listening to this podcast, you agreed not to hold the host, guests, or any affiliated partners liable for any losses or damages that may arise from your reliance on the information provided. And with that, welcome, Erik. Let's kick this thing off.
Hey, good morning, Karen. It's good to be here today. There's been a lot happening in the last week with the market, and what I would like to do this morning is take a couple minutes to talk about the Dow Jones Industrial Average. For those that follow the market, the Dow Jones is the premier index that is widely regarded as the best overall indicator of the economy and where the economy is going over the next 6 to 12 months. The Dow Jones Industrial Average, for those who pay attention, closed January 30th at almost an all-time high. Is only a couple points short, but it closed at 44,882.13 at the end of January. It has since pulled back over the course of the following 6 weeks, primarily due to concerns over a recession and the impact of tariffs proposed by the Trump administration and how those tariffs will impact the economy. For example, yesterday the Dow Jones Industrial Average on March 10th closed at 41,911.71, or basically down just short of 3,000 points, about 8% since its January 30th high. It was down officially 2,970.42. And it's down almost as we speak another 400 points today. So we are looking at a pretty significant pullback. A market correction is generally defined as a 10% pullback from its highs, and a bear market is around, which would put it down about 4,500 points, or right around the 4,000 level, about 40,300 points, pretty close estimate. And a 20% retracement or downturn is the definition of a bear market. So to get to a bear market territory, we're going to have to see about a 9,000 point drop in the Dow Jones Industrial Average.
Okay, so I heard this morning that the drop that happened, I guess at the close of yesterday, that's rebounded a little bit, was the biggest drop or the lowest point it had been in 3 years. So you're saying that it's going to go even lower, that would put it even, further out as like the lowest point that has been probably up to, 5 or 6 years ago. Is that kind of what you're saying?
I believe the decline in the NASDAQ 100 index was the sharpest decline in 3 years. That it was the largest one-day drop in almost 3 years on the NASDAQ 100. The Dow Jones Industrial Average is right now, as we speak, trading around 41,500, just a hair below that. And that really takes the Dow Jones back to its high from late September. So we've given up close to almost 6 months worth of gains in the stock market at this point in time. And if these market fears or fears over the economy persist, there's a fairly reasonable shot that we're going to see the Dow Jones Industrial Average find support around 39,400, which would get it a little bit above, that's where where it looks to me it's going to find some support and get it a little bit above bear market territory. Are we going to enter a bear market, which could run 6 months or longer? I don't know at this point in time. It all depends upon how a lot of things will impact the economy. And chief among those are, efforts to deregulate the economy and spur economic growth. But
yeah, go ahead.
I was going to say, a market pullback is not the end of the world. It is an opportunity, for investors to do some bargain hunting and evaluate stocks on, much more on their long-term, business prospects. It does have a little bit of a chilling impact on the number of IPOs that get done, and it does also reduce the valuations at which they come public. But there's also some other opportunities that could be created, things that you and I were talking about before the podcast, and maybe you'd like to share some of those with our listeners.
Yeah, a couple of things I wanted to add as to what you were talking about. So the thing that people need to understand, and this is what I'm always, because I'm an advocate of investing in private companies, because the very nature of an investment in a private company, in theory, the whole idea behind it is you're investing when the stock is at the lowest point. If it's been structured properly, the lowest point that is going to gain value with the money, because the money is directly going into helping that company do the things it needs to do to grow its business. And so when it gets to a point of being able to then go public or get acquired, the stock is at a higher price. Right? So it's going into those kind of things. Whereas a stock market, it's a transaction, it's a market. So big money can move in and out and cause a big shift. And so sometimes you have big money makers that have hedge funds that have a balanced portfolio, that they're trying to maintain the overall performance of a diverse portfolio, right? Because that's, and so they may move, and in the past when we've seen some fluctuations, it's never been exactly correlated, and this is my own opinion. I've noticed that when there's a big drop in the crypto markets, you can see a subsequent drop in the public markets because they're selling off a good stock in order to make up for a drop in a stock that they had invested in that wasn't, and to keep the balanced portfolio. So you understand that sometimes really good stocks can suddenly drop from sources outside of their control. They've got good metrics, they've got good ratios, they've got good market cap, they're growing. We see it because of and even bad stocks that, have none of those things can rally because of a social media viral kind of a stuff. So it's important as a understanding that stocks drop and grow because there's either more buyers or more sellers. So when there's more sellers, the stock is dropping. When there's more buyers, it goes up. So it is an opportunity if you are not just, cross market, if you do your homework on companies, to find undervalued stocks in this area, while they're going through this. So just, stay tuned on that and check your own ones out, and don't sell it. If you don't sell it when it drops, you haven't lost the money yet. If it's a good stock with good fundamentals, hold on to it. Now, it may take a while for it to come back, as we saw during the Great Recession when the entire stock market just blew up because of the financial markets that collapsed, because of the real estate markets that collapsed, and that whole, kind of whirlwind that we got into. That it took about a decade for most of the overall stocks to come up. Same thing when happened after 9/11. And you had whole sectors that dropped, right? Took a long time for those to come up. So if you can be patient, you can be okay with that, but it's always time to reassess your portfolio. But I like the fact that if you are taking money out of the market and trying to figure out something else to put it in, to really consider learning how to invest in private companies if you haven't already started to do that. Crowdfunding companies, Reg A Plus companies that we've been talking about, that Eric and I are real advocates of. We talked about Reg A as a way for a company to go public. A little bit later on in the conversation, we're going to talk about some of the things that big venture capital firms are doing to keep their private companies thriving, waiting for an opportunity to go public in the future when the market is more friendly for that kind of activity, right? So, there's a lot of things that hopefully board of directors are gathering up with their founders and considering and getting advice from their financial consultants, the folks like us, to say what are some of our options, in this current situation. So if it's okay, Eric, I'd like to share the news that we had, because we did have just a few weeks ago an announcement that the first company that raised $1 million as a seed stage on a Reg CF went public, raising, I think it was $100 million as part of that raise, and went at a $1 billion market cap. Let's see.
I believe it was $234 million was raised by Beta Bionics, and that's
Beta Bionics. They developed FDA cleared iLet, which is is for pancreas treatment. It's not a cancer treatment, though. I don't think it was really a pre-diagnostic treatment or something, a diagnostic treatment. But anyway, they raised money, which was something we talked about last week, which was sort of a aha moment for me on how with the right planning and strategy, you can raise a lot of money when a solid, good company gets ready to actually do the full public offering. Now, they did this as a pure IPO, not a Reg A Plus, but they did raise $1 million from Reg CF. And it was in the way Reg CF, that's the traditional crowdfunding where a company can raise up to $5 million across the nation from accredited and unaccredited investors. The way that works, they usually go into a special purpose vehicle, so they have limited voting rights and limited rights, and they do get diluted. So the the way they talked about, so like the next round probably got of true institutional and accredited investors got the biggest return, but the $1 million that went in there, they haven't published what they got as the return on investment, but they got a sizable return for a company that went public with $1 billion valuation. That is like, we were all like in the crowdfunding space, we're like doing like the dances around the room, because it shows that it works, and it is a great economic stimulus for companies like this that have a hard time, because it was a safe that you convert, right? Because we don't know what the value of the company is going to be, and you don't want to get locked in on something with a high valuation that then gets a down round and all that kind of stuff. So safes are a good way to go when a company is raising this kind of capital, if there's something that they know they're going to be raising a lot of capital down the road and get to a point of having a high valuation. So anything you want to add to that? And by the way, they're trading under BBNX if you want to go follow them on NASDAQ.
Yeah, I was looking at this one prior to before our podcast, and it's a pretty interesting story, and I think this is also a great story. The company's out there developing some new technology for the treatment and managing of diabetes, and
that's with the pancreatic stuff, yes.
Yep. And when I was younger, I lived with my grandfather for a couple years, and he was a diabetic, and I watched him have to do a daily insulin shot. And I also watched him struggle at times with, fluctuations in his blood sugar throughout the day. And that was a difficult process. And it also causes, unfortunately, some mood swings and some other things as it impacts your blood pressure and creates stress on you. So for a company to come out and be able to develop new products that help people and crowdfund them is a phenomenal part of our economy that makes life in our country such a better experience. Now, in looking at this, it looks like Beta Bionics did its crowdfunding at a split-adjusted price of about $19.70 a share. And this was an opportunity where the company was able to go out there, shore up its balance sheet, buy some time to further develop its product and become more attractive as an IPO. There was a couple additional rounds of capital raising that they were able to do prior to the IPO. And the IPO then came public on January 31st, so just about 5-6 weeks ago, at an IPO price of $17 a share. And it appears to have been, what we would call a hot IPO, because it opened up at a premium, I believe, of around $23 a share. And it's traded, according to the information I have today on my charts, as I'm looking at a chart of it here, it traded above $20 a share up until just the first of March. So it's a good opportunity for those crowdfunding investors to get some liquidity for those who wanted to.
Yeah. So let me ask this. You said split adjusted. So people out there, does that mean that where they bought it, then by the time when they raised additional capital that they got, it wasn't $19, it was more like, $8, or it was like a half price of that, or some kind of discounted value, so that when it went public there was still a gain?
According to the information I was able to find online, Beta Bionics did its WeFunder campaign at a price of originally $100 a share. So later on, they did, in order to be attractive to investors, they did a 10-for-1 forward split, where that means every one old share was replaced with 10 new shares. So that brought your split adjusted price down to $10 a share from $100. And then later on, in order to adjust the capital structure, probably for the IPO, they did a 1-for-1.97 reverse split, just a hair under $2, or just a hair under a 2-for-1 reverse. And I don't know the specifics as to why the company did this. What I have found through my experience is company management, founders, they have an idea of how many shares they should have issued outstanding, and that comes from whatever research they've done and typically talking to their accountants or their attorneys, who all have their own opinions, and they're as numerous as there are professionals in those fields. And so they select a price and a per number of shares. Then what happens is they kind of work their way up the food chain. They start to get a little bit more differing advice. And then finally they get to the investment banker who says, I think I value your company at this, and we like to raise money for stocks within this price range, and our investors like to trade them there, and so we're going to make this final adjustment just before, the IPO.
Yeah.
So that's kind of what you get. I mean, for those that have been doing this long enough, you kind of get a gut sense that when it comes time for the IPO, particularly if you're a smaller IPO, you're going to have 10 to 20 million shares issued outstanding at the time of the IPO. Or for the larger ones, you're going to be 20 to 30 or 30 to 50. You're going to fit in this category. You're going to look like an apple or an orange or a pear or whatever your favorite metaphor is, but you're going to look like that. And that's the bankers are like, this is our niche. This is where we go.
Right.
So Goldman Sachs is going to look at it different than the other guys.
Right. Well, that's one of those things we talk to when companies are early on raising capital, because if they go, like sometimes I've seen it where people like that $100 a share thing. If I had been advising them at that point, I would have told them you need more shares, because it's hard for people to imagine going public. I mean, getting a return on $100 a share. You're going to end up having to split this a bunch of times. It's going to cost you money down the road, where you just get started with a lot of shares that you can give more shares at $10 a share to start with versus one share at $100 a share. But like you say, lots of different opinions out there, and people get started and entrepreneurs just don't know, and particularly crowdfunding investors don't really know. They don't even know the difference a lot of times, and this is why I offer the Compassionate Capitalist Academy training. Learn how to be a crowdfunding investor. Learn how to look at these things and assess the value and assess what that means when there's authorized and issued shares, and what does that look like long term, and the difference between preferred and common shares and the different classes of stock. It can be very confusing, but it also directly impacts your, what you may make on those stocks and what kind of rights you have in the future. So anyway, what's our next topic?
Well, I would like to point out, I do remember one company from your Angel Group days that I won't mention the name because I forgot it, but they were an Atlanta-based company, and I went over and met with them, and they were working on a crowdfunding, and they had picked a price of something like $8.37 for their offering. And I asked them, how did you come up with that price? And they go through this big, long, complicated formula for deriving the price of their offering. And I said to them, I get all of that. But psychologically, investors think in round numbers. 5, 6, 750, 10. 12, 50, 15. They like even numbers. They like even numbers that are psychologically appealing. And I don't think they performed very well in their crowdfunding. But another important thing that I'd like to bring up before we move on: the broker dealers that specialize in crowdfunding, they are really different than the guys that do IPOs. It's a whole other mindset. They are just psychologically and culturally different types of broker dealers. And so the broker dealer that's going to help you with your crowdfunding efforts, and there's a lot of good ones out there. They are psychologically, in tune. What's the investment public? How's it going to do? How's the emotional investment? And the IPO guys are going to look at things differently, and it's important to understand that. And we'll get into that more in future episodes. But I think they're both incredibly valuable to the capital raising process and our economy overall. So, but yeah, it's interesting.
Okay, so let's. I don't see the article here, but I know I had seen something on. I had seen it on one of the newsletters, the Pitch Book, about how a number of VCs were, the big money that was in companies were buying back stocks from the private shareholders so that they would stay private longer. Have you, what's because the reason for that was that they were at a point where they were making moves and trying to think about it, but they knew that the public market was going to be frothy. And so it might be better to continue to build the value in the company and get through this phase so that they could then do a straight up strong public offering in the future and not rush it, but also gain back take some pressure off the need for exits. So have you seen that, and what's the process for a company to buy back stocks when they're still private? And maybe even on the process of buying back, because sometimes you saw that, a few years back when there were different tax structures for public companies, and instead of issuing out dividends, they bought back stock. So what are some of the motivations and the processes for doing that?
Yeah, there was a recent article on this in Pitch Book that talked about doing tender offers to their employees and early investors to buy back stock. And there's a lot of motivation for this. These startup companies that raise lots of capital and are well funded also issue a lot of stock options to their employees that can be exercised. And those employees either get the shares earned as compensation, or they have options where they purchase the shares. And over time, this will grow. For most employees in these early startups, that becomes a significant portion of their net worth. It'll become immensely valuable, more valuable than their house, their car. It reaches 7 figures. God bless them. They're millionaires. But it's kind of like owning Berkshire Hathaway and hoping for a dividend. It's not doing much for you in the moment. And there becomes a lot of pressure on these investors to monetize, get some cash for their investment, or at least a part of it, if not all of it. And what kind of comes into play is, unless the company has some really onerous restrictions on the resale of shares, it can't block the sale of the shares. And those resale provisions are not favored by, they're not looked upon favorably by state laws, and they're not looked upon favorably by deep-pocketed investors. So you find a situation where at some point people can start selling and you cannot do much to stop it. So the companies are looking to manage the process. They see this as an opportunity to buy back shares that they could then resell at a higher valuation, or hold, or buy back at just strictly a much higher valuation, and kind of use it to kind of clean up their cap table a little bit and get the stock in the hands of longer term investors at that point. I'm rather conservative. I don't think it's always the best buy, but as a seller, I would think it'd be great. And for these companies that back really deep-pocketed investors for a long term, it's a very viable strategy, and one that works, and does help them delay an IPO to the point where they can grow the business more.
Yeah, and I think we've also seen the favor of unicorns on a value that's just, the whole thing, unicorn, for those that don't really know where I forget who it was that came up with the first time used it, but it was the idea that I've never seen a company with $1 billion valuation. It'd be like seeing a unicorn, right? That was kind of like the metaphor of what it is. So they started calling these companies unicorns, and we now have like hundreds of them that have $1 billion valuation. The thing that most people don't understand about that is that valuation isn't based off of the traditional mechanisms of how you value a company, based off of their revenues or their IP or the things that, if a company was going to be acquired, what their valuation would be, right? Because you look at all of this stuff, you get some kind of multiple on EBITDA and those kind of things, but it creates a lot of buzz. But they fail, oftentimes they don't live up to their grandeur when they go public, because they don't have the operational infrastructure, their operational mechanisms to be $1 billion company. And because they've got large, deep pockets that put in hundreds of millions of dollars on top of, other rounds that then gets added to what the way values on private companies often are calculated is based off of, they put, you're a $5 million company that raises $1 million pre-money, $5 million, post-money, $6 million, and so on, right? They raise $20 million. You may grow your value to $20 million, then you raise another $20 million. Now you're $40 million. Okay, so it's like it keeps compounding on that till it gets to $1 billion valuation, and they make a table someplace that keeps track of it. PitchBook says here's all the $1 billion companies. So I think it's a good strategy for there's this term within the venture capital space called dry powder, right? Yeah. So a lot of times when you invest in a venture capital fund, they keep money aside that they don't put to work in new investments to support the good investments that are continuing to grow, so that they can have more patient money. And so that's what they're using some of this dry powder to buy back or pay, buy these stocks from, because it also creates a churn in the marketplace and speculation on a value that they don't control that narrative if these employees are out there selling their stock, which they can, or early stage investors are selling their stock because they're trying to liquidate. It creates a sense of like, oh no, is there something bad happening on the inside? So, it's a wise move. And following on to what we talk about, if you're looking at getting into private markets, for those that are not in venture capital funds and invested in venture funds and these various kind of funds, the Reg D 506C is a good way to do a true private offer from a family office, from high net worth, to be able to invest in private companies that is it's not really public, but it is public. They have the ability to advertise public, but they don't really, not like a Reg CF or a Reg A+. So anyway, I just wanted to throw that in there because we don't hardly ever talk about 506Cs for established companies that are in that. They're in that limbo land between angels and VCs, and so they will do a 506C as a Reg D offering to get another private round.
Well, and one of the things that you mentioned was venture capital firms that may need to get some liquidity or dry powder. And one of the things that most people may not be aware of is that a venture capital or a private equity-backed fund, but both of those types of funds are typically structured with a limited life. So a venture capital firm runs a series of funds, and the funds typically have 7 to 10 year life expectancies. And so as the fund comes towards the end of its chartered number of years, its life expectancy, they need to start getting liquidity to return to their investors. So when you think of big funds like Sequoia Investments and all the New Era Enterprise Associates out of California and some of the big ones, those are actually over the life of those management companies, they've probably raised 7, 8, 10 funds at this point in time. So the venture capitalists who originally backed a company are in a position to put a lot of pressure on these firms to go public or arrange private transactions to create that sort of liquidity. And so that is also one of the driving factors. I do know that, for example, that they did mention that Stripe, the payments processor, and
yeah, that's one.
For the record, we use Stripe at our issuer services division, that they have participated in or launched a tender offer for some of their employees and early investors. And what that does is it allows them to remain private at a higher valuation and delay going public for a few more years. But eventually, my professional opinion is that we will see Stripe either go public or get bought out at a high value.
Yeah.
And those are two very viable options. I will tell you that I have seen some offers through some broker-dealers I know on the private transaction side where a couple of these companies are opening it up in the private markets, as we discussed, for new investors to come in and replace existing ones. But it's a high bar to entry. Your minimum investment on a couple of these is well into the several $1 million range. So that excludes most mom and pop and small funds, because you could be stuck in one of these for a very long time. And if you have an Elon Musk type investor, he doesn't necessarily think that every one of his companies needs to be public. Because he doesn't need the exit.
Right.
And that's your risk you take. So, one of the other things we need.
Yeah, let's switch over. Let's talk about this thing that we spent some time last week talking about reverse mergers and the pink sheet and sort of like the role that played in the evolution of the stock market over time. And there's some new laws coming down on the OTCID basic market. You want to talk about that, Eric?
Yeah. So what we've seen recently is OTC Markets announced some changes to its structure. And OTC Markets is an information disclosure service. It's actually comprised of a couple of things. It provides quotes for over-the-counter companies. So when you see a OTC listed company traded company, and you get a quote on Yahoo, or if you have a quote service or your broker-dealer provides quotes, the over-the-counter market is not actually an exchange. It's not a stock exchange. It's a semi-deregulated market. And what OTC Markets does is it maintains what's known as an interdealer quotation service, where it allows broker-dealers that make markets and securities to publish quotes electronically, and so that trades can be executed. And then it runs an alternative trading system, which is like a light exchange, a mini exchange, that executes the orders, processes the orders for settlement purposes. And so the OTC Markets group was originally known as the Pink Sheets. It was a division of National Quotation Bureau. And the reason it was called the Pink Sheets is because quotes were published in booklets containing long, narrow strips of paper that were pink in color. And hence they got their names. And they also published bond quotes, which were on similar sheets, and they were on yellow sheets. And so when you were a broker in the late 80s, and you worked at any place that did over-the-counter trading, you'd see stacks of these pink sheet papers laying around, and occasionally you'd see something yellow if you had a bond department. And so over the years, they've modernized that service, and probably a good decade or so ago, they announced the OTC QB. They split the over-the-counter market in their view into three divisions. The pink sheets, the QB for companies with a moderate level of disclosure, and then the QX for the top tier of over-the-counter.
Wow.
And they're at SAT. They're at SAT for a while. And as they went along and they improved their disclosure service and tried to become more compliant with the regulations, and then there were some rule changes proposed back in late 2020 for the over-the-counter market regarding Rule 15C211, which allows for the publication of quotes on the over-the-counter market and for the solicitation of securities on the OTC. And so OTC Markets, which is a private company, proposed what they call the expert market. Those securities that have extremely limited disclosure that would trade, and but only the most sophisticated of investors, so-called experts, could buy and sell. And then they had the what they called pink current, the lowest level of full disclosure for a over-the-counter company. And you could be either fully reporting by filing your reports with the SEC, or you could provide alternative disclosure where you would be non-reporting and you're not necessarily required to have audited financials. And then in September of 2021, the new rules went into effect. And the expert market was kind of left out. They had proposed during the solicitation of comments for the proposed rules, OTC Markets submitted a bunch of comments, several which proposed the actual creation of an expert market. And the SEC kind of ignored that and left that out. I remember that.
So wait, I got to stop you for just a second.
All right, go ahead.
So what does you mean by expert market? Like who buys them, or the companies, or like that? That just seems like really arbitrary that you've got all these different, I mean, ID, BB, QB, QX. It almost sounds like the CBD market with all the different things they throw on the end of this stuff to describe the THC inside of it. So, for the people that aren't familiar with some of the terms that you're saying, just back it up for just a second, and what does it mean? Like with the new announcement, does that mean that all that's going away and it's just going to be the one ID? So
the QB and the QX are still going to remain, and they have done a pretty decent job of getting kind of a segmentation of the quality of the companies. So you can think of the OTC QX, which is the top tier, as companies that are not quite ready for an exchange, or that find the cost of being on an exchange to be too great, and they want to save money by being on the over-the-counter market, and that applies kind of like to domestic companies. Now, foreign companies can qualify for foreign companies can qualify quite easily for the QX, but in terms of domestic companies, the top two tiers are still going to remain.
So is expert because of their potential market volume or something? I mean,
so the expert market is for companies that are not current in their disclosure. So Pink Current is kind of going to get a new name. It's going to become the OTC ID. And in looking at that, while I have not reviewed all the new application forms, it's basically the same process. You're going to have to subscribe to the disclosure service, which is your ability to publish information up to OTC markets, and provide certain management certifications, among other things, that you're not going to do anything that you're not supposed to.
Okay, so then ID, so like at the end of the day, ID is they're going to be the ones that are just small and fully trading, and the other ones are all ones that have some kind of limitation on them.
Yeah, the idea is going to be, say you don't meet the requirements for the QB, but you're fully reporting, or you've got the alternative disclosure, but you're current in your disclosure. You're providing what the regulators, consider to be at least the minimum or more information to be a public company.
Okay, so it's not that revolutionary. It's just really cleaning up stuff that they really needed to clean up all along, and they're finally getting around to it.
Yeah, and Pink Limited is limited disclosure. You're behind. You're delinquent. You're not current. Your auditor got suspended and you haven't been able to re-audit. Something like that could happen, or you just you've fallen out of compliance for some reason, and that's where you're going to sit to get back into compliance.
Okay. So in the time that we've got, because we don't want to make it too long and hurt people's brains too much, let's, and you might have another topic, but the one that I wanted to talk about and get your take on is this sort of groundswell or stuff, I don't know, where a state, like the state of Texas, is looking at and working it through their legislative body, I guess, to create their own stock market. And because, Texas likes to go their own way on a lot of things. We saw how well it was with the power grid, where they had their own snowmageddon out there, and Arkansas had power, but Texas did not, right?
Yeah, that's an interesting one.
Right? We see a lot of things that they do, oh, yeah, and we've got deaths from measles in Texas right now. Yay, because of, anti-vaccine. And so, they're going to go do their own stock market because Texas is better. What does that really mean? When they start competing against stock markets that have been established for decades and generation, they're competing with issuers to want to issue that doesn't have as many purchasers there, and it's just like a startup of another kind of commercial marketplace where we always say you got to get your buyers and sellers there before you can be successful. What does that really look like? Because to me, that seems like it's a crazy thing for a state to try to go and create their own stock market and compete with these national platforms.
Well, so a couple things about the Texas Stock Exchange. It is registering with the Securities and Exchange Commission to be what is known as a national securities exchange. So the Texas Stock Exchange is backed by private investors, some institutional and some wealthy individuals. The Texas Stock Exchange is going to compete for companies all over the nation and worldwide to be listed on their exchange as a trading venue. But this is where things get a little bit interesting. All these stock exchanges, the New York Stock Exchange, the NASDAQ, the CBOE, the old Chicago Board's option exchange, the Midwest Exchange, and any other ones that you can think of, every single one of them is headquartered in a state. So they all are incorporated within a state. And as state chartered entities, we do not have federally chartered corporations, they are also subject to the rules and regulations of the state where they are incorporated. So if you're a Delaware corporation, you are subject to the rules and regulations of the state of Delaware. And you're also subject to the rules and regulations for where you do your business. And so if you have a physical, if you have a physical location in New York City, or if you're purely an electronic exchange like NASDAQ, and you have servers in New Jersey, you're subject to the laws of those states. So what is happening is Texas is basically saying, as a state, we are regulatory light. We are not going to impose certain laws or rules and regulations on you that are going to cause you a lot of headaches if you're listed here. And then we're going to take a regulatory light approach. So come list in Texas, and you don't have the headaches of New York meddling with the state of New York or state of New Jersey meddling with your listing. And that's really what it's going to come down to. And then it's going to come down to a symbolic listing, because as I've mentioned, once you're on an exchange, your trades can be executed on any exchange, the so-called consolidated tape and consolidated price discovery. So broker-dealers can then route the trade execution to whatever exchange they so want. For example, some guys... Go ahead.
Well, I was going to go back to the regulatory light piece of this. So does that mean, because the SEC are they still beholden to the SEC for transparencies and filings and stuff, or if they're, they don't, or they don't, like, basically it's going to be, the Wild Wild West, because anybody can do anything if they're, regulatory light. They don't have the same rules and protections for stockholders and disclaimers and transparency of filings that they do in some of the other markets?
No, that's actually an excellent question. So the companies that trade on the exchange are going to have to provide disclosure pursuant to the SEC rules and regulations, because by being registered with the SEC, they're going to have to basically follow the SEC rules that govern trading on national stock exchanges. Where this gets interesting is, historically, all the stock exchanges had their own self-regulatory organizations. So they would create independent bodies, even though they were quasi-captured by that exchange, that would regulate their members and the companies listed on those exchanges. And they would create their rule books that would go through a formal review and approval procedure, an amendment procedure, and those rule books would conform to standards, that were ultimately dictated by SEC regulations. But then, about 18 years ago, things got kind of interesting, because these exchanges that were effectively member-owned, kind of like co-ops, began to convert to for-profit entities. And they kind of felt that for-profit entities should not be in the regulatory business, or at least public companies should not be in the regulatory business. So the New York Stock Exchange, which had its own self-regulatory organization, combined with the National Association of Securities Dealers to form FINRA, the Financial Industry National Regulatory Association. That's a mouthful at times. But
we love FINRA. We love FINRA. Get that on the algorithm.
We won't get into the stories told by people that went through that process, because they're not pretty.
And FINRA is not a very, very investor-friendly, market-friendly organization either.
It's not a very issuer-friendly organization either. I can tell you stories of companies that have taken months, 9 months, working on a simple name change. or changing domicile. I can tell you a horror story about.
Man, maybe Musk will go in and slash FINRA.
So there is a move to have FINRA consolidated with the SEC. There's a lot of industry research out there that talks about FINRA being a little bit off the rails at times on a regulatory side, and the need to either split FINRA into separate organizations or fold it back into the SEC.
Because it's a quasi-regulated organization. It doesn't actually have any oversight, right? There is no recourse. When they file charges against an issuer or a broker, you basically almost have to give in, because there's very little you can do to fight that. They don't have a mechanism for recourse. I mean, I know that's the way it used to be, to do an appeal.
Yeah, so it's tough. They do maintain their own internal adjudication court system, and there is a lawsuit currently before the Supreme Court that may declare those courts unconstitutional and basically defang FINRA.
That would be something.
There are several broker-dealers that have challenged FINRA's rulings. Particularly the most notable would be Alpine Securities. And when they didn't like the FINRA ruling, they challenged it they took it to the federal courts. Well, they took it to the SEC. And then when they didn't like the SEC's ruling, they took it to the federal court system. But
yeah,
that's expensive. And very few broker-dealers have the capital with wherewithal to do that. I mean, they don't have the money. Very few guys can do that and still turn a profit. So fighting with FINRA is problematic.
I know. So anyway, it looks like we might get some common sense that goes in there, because I had also heard that they don't have a real budget that's approved by Congress or anything like that. It's
No, they don't.
fines. It's fines, and they've
don't.
grown. And it's just because of the fines that they collect from the broker-dealers and the issuers that pay their bills. So
FINRA's lost a lot of money over the years, and a friend of mine kind of runs an exchange for broker-dealers where he helps facilitate the purchase and sale of broker-dealers. And he publishes a newsletter and talks about the fact that FINRA has lost hundreds of millions of dollars a year for a long time, and that FINRA is losing money since inception. So the fact that they fund themselves off the back of the fines, particularly that'll fall very hard on small broker-dealers, is problematic. And the number of broker-dealers has declined dramatically since the formation of FINRA. There was approximately 7,500 broker-dealers in the United States when FINRA was formed in 2007, and now there's about 3,000.
wow.
So it's an over a 50% decline in the number of broker-dealers. And these small broker-dealers can be the lifeblood of capital formation for small businesses and help really create the job growth in our economy. Where things in Texas are going to get interesting is if you go to the SEC's website and you look at all the national exchanges listed, you'll see that almost every single one of them, to the best of my knowledge, every single one of them is regulated by FINRA. They have outsourced their regulation to FINRA. Now, there's a rumor that the Texas Stock Exchange is not going to do that. And then the Texas Stock Exchange can establish its own SRO, self-regulatory organization. And all of a sudden there's competition. So a broker-dealer could register with either one of the SROs and choose to be regulated by either FINRA or the Texas one.
Yeah.
But because it is the way the rules are written, you can still transact with other broker-dealers that are appropriately registered. So you could still execute over-the-counter trades, or you could execute trades on an exchange. And by the consolidation or the interweaving of quotes and the execution services provided, you could have broker-dealers running trades legally that are not members of FINRA. And that will change things.
Watch this space.
And so this Texas Securities Exchange is probably going to get some legs, particularly if all of a sudden there's a second SRO out there.
Yeah.
And, what that ultimately does to FINRA, and does FINRA maintain its monopoly, so-called monopoly on regulation of the over-the-counter market, that's going to become real interesting to remain to be seen. I think at some point, if there is a second SRO, FINRA would not be the final arbitrator on the OTC. And it's been rumored that FINRA would like to get out of that business. It's not a good fit for it.
You might have heard it here first. Watch your space, and remember, this is not financial advice.
So we'll see what happens on that. There's going to be news. We'll get into a whole podcast on that.
It probably take a year, right? I would think with all of the mess and what we got going on right now. So here, we got just a couple minutes left.
Yep.
I think next week, the way our schedule is, we're supposed to do a deeper dive into some topics that we hit in the first week, and then we have a guest. Is that right? Do you have a guest lined up for next week, or is it the following week?
No, I believe I have a guest lined up. I'm going to kind of keep quiet on our friend's name till we get everything 100% confirmed. But I spoke with a friend of mine this morning who closed on the purchase of a broker-dealer last night, made the official announcement. I think he's going to be a very interesting guest. He's been involved in the capital raising process for several other investment banks. I've known Rich for a very long time. He's might be a little bit out of the bag, but he's also been involved in various aspects of the capital raising process. When I first met him, he was active in rights offerings, which is a capital raising tool for already existing public companies and some private companies. In fact, we had a bank client that did a rights offering a couple years ago, and it's privately held. He then moved over and was the head of investment banking at a small BD that's active in IPOs, and he has since moved over to help create his own shop with a couple partners. And he's a bright guy, and I think he'll provide some good insight for us.
Yeah. Okay, great. So whether we do that next week or the week after, stay tuned. Make sure you're subscribed to the Capital Conversation newsletter so you can get the announcements and hear about these what's coming up next on the live on Erik. Follow Erik on or me or both of us on LinkedIn, and also I think we might put out a survey to gauge what people would like to hear more of when we do the deeper dive, whether that's next week or the following week. So stay tuned for that. And my closing is always onwards and upwards. Let's go, create some compassionate capitalism, wealth. And what you got to say, Erik, or did you say goodbye?
Well, before we go, I'd also say I can be followed on Twitter, now called X.com, at Sterling Investments. It's at Sterling, INV. And we're also on with at Coral Capital on Twitter as well, a couple of accounts that I maintain there. And we're going to work to get this up on Spotify and a couple other sources. And pretty soon we'll have these on YouTube for your viewing pleasure as well. So until next week, everybody enjoy the warm weather that is finally starting to spread across the country. Oh, and one final thing. I'd like to give a shout out to a local business in our area called Nothing Bundt Cake. Bundt Cake makes very high-end cakes and pies for the public. And our local store had a surplus one day, and so they dropped some off at the office because they were, as they drove by, they decided they'd distribute them to various businesses. And I can tell you, it was an excellent cake. So if you are in need of a cake, we shared it at the office and at the house. I'd like to recommend the nice lady from Nothing Bundt Cake, who I never got to meet, but she made an amazing cake.
I love that. On a sweet note.
Yes, and it was good, and my boys loved it, all three of them. So, it was
all right.
Good.
All right, thanks, Erik. It was a great talk.
All right, thank you, and we'll see everyone next week.